Decoding financial jargon, understanding key terms for beginners. Welcome to Decoding Financial Jargon, understanding key terms for beginners. If you're new to investing, the world of finance can seem packed with confusing terms and concepts. But don't worry. In this video, we're going to simplify these ideas, one term at a time, so you can gain confidence and start your investing journey. By the end of this video, you'll have a clearer understanding of important investment terms, allowing you to make informed decisions while building a solid financial foundation. Let's start with the basics. First, what are stocks? Simply put, a stock represents a share of ownership in a company. Imagine a company as a big pizza. If you own one slice of that pizza, you own one little part of it. That slice is your share. Stocks are an investment. When the company does well, your share of the pizza may grow in value. Now let's talk about dividends. Dividends are rewards that companies give to their shareholders, often as cash payouts. Think of this as a thank you gift from the company for investing in them. Not all companies provide dividends. Some reinvest profits back into the business instead. By understanding stocks, shares, and dividends, you've already taken your first step into grasping how investments work. Now that we've covered the fundamentals, let's move on to key metrics. These help you evaluate the performance of your investments or a company you are interested in. Market capitalization, or market cap, reflects the total value of a company's outstanding shares. It's calculated by multiplying the current stock price by the total number of shares. Companies are often classified as small cap, mid cap, or large cap based on this value. Large cap companies tend to be more stable, whereas small cap companies can offer higher growth potential but carry more risk. This term refers to how much risk you're willing to take as an investor. Are you comfortable with taking on high-risk, high-reward opportunities, or do you prefer safer, more predictable investments? Knowing your risk tolerance helps you craft a portfolio that aligns with both your financial goals and comfort level. Volatility is the up and down fluctuation in the price of an investment. Highly volatile assets may offer significant returns but can also carry greater risks. On the other hand, less volatile assets are more stable and predictable. EPS shows you how much profit a company generates per share of stock. A higher EPS indicates higher profitability. Meanwhile, the PE ratio compares the stock price to its earnings. It tells you whether a stock is potentially overvalued or undervalued relative to its profitability. These metrics are essential when deciding which stocks to invest in. When starting out, you'll come across different types of investments. Let's break them down. Bonds are essentially loans you give to companies or governments, which promise to pay you back with interest. They're considered low-risk investments, making them a good choice for beginners. These are collections of stocks, bonds, or other securities managed by professionals. Investing in mutual funds allows you to diversify without picking individual stocks. ETFs are similar to mutual funds, but are traded like stocks on exchanges. They offer diversification with the flexibility of stock trading. Index funds track the performance of a specific market index, such as the S&P 500. They're highly recommended for beginner investors since they're low cost and diversified. Retirement funds like 401(k)s and IRAs are long-term investment accounts designed to help you save for the future. Contributions to these accounts often come with tax benefits, making them a smart choice for building long-term wealth. Investing successfully also requires understanding certain financial processes. Let's look at a few. Compound interest allows your investments to grow exponentially over time. Essentially, you earn interest on your principal and on the interest that accumulates. The earlier you begin investing, the more time compound interest has to work in your favor. This is one of the golden rules of investing. Diversification means spreading your investments across different asset types, industries, and regions to minimize risk. As the saying goes, don't put all your eggs in one basket. Asset allocation divides your investment portfolio into categories like stocks, bonds, and cash. It should be tailored to your financial goals, age, and risk tolerance. For example, younger investors may hold a higher percentage of stocks for growth potential, while older investors might prioritize bonds for stability. Liquidity measures how quickly you can convert an asset to cash without losing value. For example, individual stocks are relatively liquid because you can sell them quickly on the stock market. Real estate, on the other hand, is less liquid because selling a property takes time. Understanding how the market functions is key to executing your investment strategy. Here are some practical insights. A bull market represents rising stock prices and general optimism in the market. while a bear market reflects declining prices and investor caution. Recognizing these market trends helps you plan your investment strategies. A market order instructs your broker to buy or sell a stock immediately at the current market price. A limit order, on the other hand, sets a specific price at which you're willing to buy or sell. Limit orders give you greater control over your transactions. The bid-ask spread is the difference between the highest price a buyer is willing to pay, the bid, and the lowest price a seller is willing to accept, the ask. Understanding this concept helps you execute trades more effectively. DRIPs automatically reinvest your dividends into more shares rather than paying you in cash. It's a great way to grow your investments over time without additional effort. We've now covered a lot of ground, but it's essential to have a few tools and tips to help navigate the investing world. Sometimes complex terms and concepts are best understood through visuals. Charts, graphs, and animations can simplify ideas like asset growth or market fluctuations. Don't hesitate to take advantage of these resources. Start small. Don't feel pressured to invest large sums of money right away. Start with what you're comfortable with. Ask questions. Engage with financial experts or online communities to clear your doubts. Define goals. Know why you're investing, whether it's for retirement, buying a house, or simply growing your wealth. Use reliable platforms, apps, and tools to educate yourself. Look for resources that offer beginner-friendly explanations and trusted investment recommendations. Some popular ones include Investopedia, apps like Robinhood and Acorns, or books like The Simple Path to Wealth by J.L. Collins. Congratulations, you've taken a significant step by decoding some of the most common financial jargon. Investing may seem overwhelming at first, but with a good grasp of these basic terms, you're better equipped to make informed decisions. Remember, investing is not about making fast money, but building steady long-term wealth. Use the knowledge you've gained today to start small, stay consistent, and always keep learning. The financial world is now a little less confusing, and your journey as an individual investor begins here. Thank you for watching Decoding Financial Jargon. Don't forget to like, share, and subscribe for more educational content designed just for beginner investors.